Welcome back. So this will be episode 10. We are still on forex trading for beginners. So if you are not a beginner and otherwise, check on the page for the other levels and then do that. So this is episode 10, and then we are on types of charts. Like I said earlier, our main focus is on technical analysis. And then technical analysis, we just look at the types of analysis, right, in the recent video. And then we have three types of them, right? And then the one that we are supposed to look at very closely is the technical analysis. And then we learned that the technical analysis, their most important tool is a chart, right? Without the chart, they can't do anything. It is the chart that gives them the foresight, right? So we are going to look at the types of charts, right? And then that's the technical analyst can actually use. So without further ado, we just zoom in and then just deal with it. So basically we have three types of charts when it comes to technical analysis. Yet there's one particular type that most traders actually take, right? They actually use, and it's very easy to use, right? So we have three types of them. We are going to look at them, and then at the end of the session, you know which of them that we can actually use to for advantage, right? So we have right, we have three of them. So this is a chart. The one that you see on your screen now is a chart, right? So this is the tool that the technical analysts actually look at. Whatever is done on it is not for fun, right? They are actually some indicators, in fact, some signals, some tools that actually help the trader to actually know what is going to happen in the next minutes or hours or right, whatever. So that is it. So now let's look at them, types of charts. Now, in order to study how the price of a currency moves, right, you need some sort of way to look at its historical and current price behavior, right? The things that we actually use is the history and then what we are seeing at the moment. And then with these two, we can actually guess on what is going to happen in the next future, right? So now a chart, or more specifically, a price chart, happens to be the first tool that every trader using technical analysis needs to learn. A chart is simply a visual representation of a currency's price, right, over a set of period of time. Right now, it visualizes the trading activity that takes place during a single trading period, be it 10 minutes, 4 hours, 1 day, or 1 week, right? We also look at the time frame, right? We look at that. I think we have already looked at that, yes. And you look at the type of traders. You know what? I think that will be the next episode, right? So that is it. Now, any financial assets with price data over a period of time can be used to form a chart for analysis. Now, price changes are a series of mostly random events. So our job as traders is to manage risk and assess probability, and that's where charting can help. Now, charts are user-friendly. They are very simple to use, user-friendly, since it's pretty it's pretty easy to understand how price movements are represented over period, since it is so visual. Right. Now, with a chart, it is easy to identify and analyze a currency's pairs movements, patterns, and tendencies. On the chart, let's say the y-axis, that's the vertical, the y-axis, the vertical, and then the horizontal being the price what? Yeah, the price scale. The x is the horizontal axis, and then the y is the wait. On the chart, the y-axis, which is the vertical axis, represent the price scale, right? And the x-axis, the horizontal axis, represents the time scale, right? So that is it. We look at that but in the better way. The prices are plotted from left to right across the x-axis. The most recent price is plotted furthest to the right. Back in the day, charts were drawn by hand, right? By hand. Fortunately for us, Bill Gates and Steve Jobs were born and made computers accessible to the masses. So charts are now magically drawn by software, right? A price chart depicts changes in supply and demand, right? Now, a chart aggregates every buy and sell transaction. That financial instrument. Financial instrument is just the currency that we're going to deal with, or the commodities, whatever, right? At any given moment. A chart incorporates all known news, as well as traders' current expectations for future news. When the future arrives and the reality is different from these expectations, prices shift again. Now, the future news is now known news. Whatever you're anticipating is now known, is now what you have currently, right? And with this new information, traders adjust their expectations on future news. The cycle repeats, right? So what it means is that using your historical data and then what we have now, we anticipated that in the next few minutes that in fact the prices or the market was supposed to move some way. Now, when the time that we anticipated, let's say 1 hour time, and then it's actually due, and then whatever we expected wasn't that way, now we may be forced or prone to what? Change our perspective again. That's what happens. So sometimes you do analysis, you get the time, you anticipated a buy, now I want to go to that time, it was actually sell. So what do? You have to what? Readjust yourself. So it is very repetitive, right? So that's what we do until we actually what come up with whatever we expected, and then maybe we are profitable, right? So your anticipation can be correct, it can be wrong. That's what we are talking about. Now, charts blend all activity from the millions of market participants, whether they are humans or bots, right? So it means that humans can actually trade, and then we have some software, AI, right? Sometimes call them EEA, right? Experts, advisors, and all that. Sometimes even use bots, right? In their trading. That is it. So whether the transaction occurred by actions of an exporter, a currency intervention from a central bank, trades made by AI from a huge hedge fund, a discretionary trade from retail traders, right? A chart blends all this information together in a visual format, right? That the technical traders can study and then analyze. Whatever. So whatever is happening, whether it was done, the trading was done by a bot or human, all these things are represented on your chart. So that is it. Now, let's take a look at the three most important popular types of price charts, right? The type of them, we have three. We have line charts, we have bar charts, we have candlestick charts. These three are what we are going to learn. But at the end of the day, or at the end of this session, what I'm going to advise you to use is what? The candlestick pattern. Why? Because it's the convenient one, the most popular one, and the easier one to use. That is it. But we are still going to have a fair understanding of what the other two, right, are. Now, first of all, we are going to look at what? The line chart, right? A line chart is what? Is simply drawn or draws a line from one closing price to the next what? Closing price. This is an example. We told you the price levels are on the vertical, and then the time frame or the times are on the what? On the horizontal, right? So this is telling you that this is how the prices are represented. Now, doing this is very difficult, right? Even though it looks simple to you, but when it comes to doing the practical analysis, this line chart is very difficult for you to know the opening price, the closing price, and then what is actually going to happen in the next minute. It's difficult to do that, right? So don't worry. This is a line chart, a typical way, the typical one, right? Now, when strung together and put together with the line, right, we can see the general price movement of a currency pair over a period of time. It is simple to follow. but the line may not provide the trader with much detail about price behavior within the period. Like you see what I just said, right? Now, let me even tell you before we even proceed. Now, the line chart is actually used to give you a general overview of whatever the price action is, right? It gives you a general overview. Sometimes you can actually use the line graph or the line chart just to have an overview of what the market is doing or has been doing, or the market date, just to give you overview. But when it comes to the analysis, actually, you have to use the candlestick, right? So this gives you the overview. It's simple, but you can't use it to what? Do your analysis, right? Conveniently, I should say. Now, it is simple to follow, but the line chart may what? Not provide the trader with much detail about price behavior within the period, right? Now, all you know is the price closed at what? X at the end of the period, right? You have no clue what else happened. You don't have you don't have idea of what actually happened, but the candlestick can actually provide you with that. Now, but it does help the trader see trends, right? See trends over easily and what? Wait, it does help the trader see trends more easily and visually compare the price, the closing price from one period to the next. This type of charts is usually used to get a big picture, like I said, an overview, a big picture, a view of price movement. The line chart also shows trends, the best, it shows the trend. Wait, I think I have to relax here. Wait, stay with me. Now, the line chart shows trends the best, which is simply the slope of the line, right? I think there's no this is not meaningful to me, right? Just scratch it. Let's go ahead. Some traders consider the closing level to be more important than the open, high, or low. By paying attention to only the close, price fluctuations within a trading session are ignored, right? So let us put it together. The other one was just a simple one, right? This is also simple, but this will give you a better representation of a line with graph. This is taken from Wall Street IG site, right? So that is it. So this is how it is. A line. It gives you that line, zigzag going, moving up and down and all that. So that is it. It's as simple as that. Now let's move to the second type. We have the bar chart. A bar chart is a little more complex than what we just looked at, right? Now it shows the opening and closing prices, as well as the high and low. Every market will have the opening and will have to close, depending on the time frame that you use, right? I think we have treated time frames and all that. So you just have to look at that. Now, bar charts help a trader see the price range of each period, right? So look at that. So this is a typical example of a price opening and closing, the high and then the low, right? So that is it. This is a bar chart represented in the form of bars. Like if you know what is a bar chart, at least I think the elementary school we did something about bar graph, bar charts, histogram and all that. I think you have idea of that. So this is just a simple representation of what bar chart in FX. So that is it. Now bars may increase or decrease in size from one bar to the next, or over a range of bars. The bottom of the vertical bar, the bottom indicates the lowest what traded price. This, right? Over the period, while the top of the bar indicates the highest what paid what price. Now the vertical bar itself indicates the currency pair's trading range as a whole, ranging as in where it started and then where it ended. So that is it. Now, as the price fluctuations become increasingly volatile, right? The bars become what? Larger. Volatile means more volume, more money into the system. trading activities is becoming more. That is volatile. I think in the intermediate class, you have a better understanding of that. I don't want to waste time here. This is very what basic. So I won't waste time here. Now, the fluctuations in bar size is because of the way each bar is constructed. The vertical height of the bar reflects the range between the high and the low price of the bar period, right? The price bar also records the period's opening and closing prices with attached horizontal lines. I think you have the look at it, just picture this, right? So this is it. Now, the horizontal hash on the left side of the bar is the opening price, and the horizontal hash on the right side is the closing price, right? Look at it. This is what we are talking about. This is the opening, and then this is the closing. Now, don't worry. This may look you may not have appreciated the understanding here, right? I am not going to waste time because my focus is not on this, but I'm just giving you an idea of what it is. Usually, you even rarely see these things, people using this. Some people, some experts use this, but normally, most of us use the candlestick. So that's my focus. So just let's continue, right? So this is an example. Putting a number of them together in a chart, this is how it looks like, right? So one opens and closes, square it closes, another one opens. So in that order, they are interlinked together. So that is it. I think you are appreciating it made like this. So we are going to continue. A bar is simply one segment of time, right? A bar is simply one segment of time, whether it is 1 day, 1 week, or 1 hour. What it means is that anytime you do analysis or enter a trade, this trade that you entered is actually on one of the time frames. It could be 1 minute, 5 minutes, 1 hour, 4 hours, 2 hours, daily, monthly, even yearly, right? So this is what it means by that. Now, when you see the word bar going forward, be sure to understand what time frame it is referencing, right? Now, bar charts are also called OHLC charts because they indicate the open, O, open, H, the high, L, the low, and then the C for close for that particular currency pair. So you see this thing on your chart, on the top left, whenever you open a chart, right? It is there. Now, let's look at what is the open. The open, right? The little horizontal line on the left is the opening. We have already looked at that. The high is the top, the low is the bottom, the C is what? The other side on the right. The other small pointed protruding side is on the left. That is the close. I think that is fair. Now, my main focus is here, right? And that is what is called the candlestick charts. So why is it called candlestick charts? Because it looks like a typical candlestick, right? A candlestick, when you light it, there's a small wick at the top, right? Forgive my drawing, right? I think this is too bad. This is too bad. In fact, that is it. I don't have to draw anything again. That is the candlestick chart show the same price information as a bar chart, but in a prettier and graphical format, right? This is much better, but far better than the line and then the bar charts, right? The candle, because of this, the wick down and up, and then the body actually is there. So one of them is what? A candlestick. So a number of candlesticks form on the chart to actually know the general movement of the market. That is why you see them combined. But one is what is called candlestick. So this is how it looks like. So that is it. Now, many traders like this chart because not only is it prettier, but it is easier to read. Candlestick bars still indicate the high to low range with a vertical line. However, in candlestick charting, The latter block, which is called the body, in the middle indicates the range between the opening and close, right? The opening and close of the what? Of the price. So let's look at this. For example, this is the body. This is the body that we are talking about, right? And then at the top of it will be the opening or closing, and then just vice versa here. Now, why am I using open or close at one point? Because it depends on what type of candlestick it is. Is it a bullish candlestick or a bearish candlestick, right? We look at them, I think, as we progress. So I don't want to waste time here. So that is why it is. So each of the candlesticks, whether in a chart, whether in a bar chart or a line, whatever, there's an opening and closing. That's the important thing in the market, right? So that is it. Now, here, candlesticks help visualize bullish or bearish sentiment by displaying bodies using different colors, right? So this is where you have to know the nature of that candlestick, what type of candlestick it is. So sometimes, in order to know that conveniently, we use colors to represent the candles, to know what type of, is it bullish or bearish? We have two types of candlesticks. We have bullish candlesticks and bearish candlesticks. You look at them as you progress. No problem. Now, traditionally, if the block in the middle is filled or colored in, then the currency pair close lower than its open, right? No worry, I will explain here. Now, so this is what it means, right? Now, this is one type of candlestick, right? And this is another type of candlestick. Now, you may ask me why are the colors different, right? The colors are different because of the opening and closing what position of on that candlestick, on that market. You can also say that on that market, right? So is the opening and closing that determines if the candlestick is bullish or bearish. Now, when it is bullish, we have a color that we represent with it. It depends. It's subjective. It depends on what kind of color you want to use for your convenience, right? So in this book, actually, we are going to use the red for the bearish candle, and then the green for the bullish one. But we are going to first start with the white and black. So if you see white, it's a bullish candle, and if you see black, it's a bearish candle, right? For now, just hold on to that thought. So that is it. Now, this candle is, like we said, is what bullish candlestick because of what the nature or the position of the opening and closing. Now, any candlestick, right, that has the price opens at the bottom and the closing at the top is what is called a bullish candle. I'm taking that again. Every candlestick or every market that opens at the bottom and then the closing is above the opening, that candlestick is called a bullish candle. It's as simple as that. Now, the lowest point of it is called the low, and the highest point of it is called what? The high. The lines that look like tails, right? The tail are called what? The shadow, or better say wicks. You can call the upper wick if they are at the top. If they are at the bottom, you call them lower shadow or lower wick. It's as simple as that. So your main focus should be on the opening and closing, just to let you know if this candlestick is bullish or bearish, right? So let's move to the bearish candle. Now, the bearish candle has the opening price at the top. It's just a vice versa for the bullish one. So the price opens at the top for the bearish and closes down below the opening. So this is as simple as that. The wick and then the high and they are the same. There's no change in that. The only difference is the opening and closing. So after this, then you can decide what. There's a setting that you can actually do in your MetaTrader or even your trading view. So that is as easy as that. Then we teach you how to go around it. Now, so here at CMB Aura Space, right, we don't like to use the traditional black and white candlesticks. It's why? Because it confuses us. It confuses me. I am the one teaching you. So I prefer the green for the bullish and then the red for the bearish. In fact, I am not the only person adapting this style. In fact, a lot of the traders, either amateurs, intermediate, or the experts, we all use the red and then the green. It's very convenient. You barely see traders using different colors. So that is it. So it's what? It's relative. It depends on what color you want to use. But if you want to stick with me, stick to what? The red and then the green. For us to be on the same page. Now, and since we spend so much time looking at charts, we feel it is easier to look at a chart that is what colored, watch TVs and all that, right? So that's convenient. It's lively. It's very nice. Now, we simply substituted what green instead of white and then red instead of black, right? So this means that if the price closes higher than its what open, that kind of set will be what green, and vice versa goes for what the red. Now, in our later lessons, you will see how using green and red candles will allow you to see things on the charts much faster, such as uptrends, downtrends, and then possibly the reversal points, right? For now, just remember that on Forex charts, right, we use red and green candlesticks instead of black and white. And we will be using these colors from now on. So bear that in mind. Now, with that being said, let's have this representation. So like we saw just a few minutes. Now we have represented the colors with what? The colors that I said we are going to use. So the green for bullish, and then the red for the bearish. The colors were just changed. Nothing changed, right? So we still have the opening there, and then close there, the opening there, and then the close there. In these two types of candlesticks, right? Bear in mind, there are two types of candlesticks, bullish and bearish. There's no any other candlestick again. So that is it. That's how, so now putting them together, the red and green, it happens. So in a chart, a red can form, a green can form, a red can form, a green can form in that order, or sometimes a number of greens or one color can form for a number of times, right? For a period, green throughout here until here, and then green continue, right? Red throughout here, and then here a mixture of them, right? And then the red came again. So that is it. Now, the purpose of candlestick charting is strictly to serve as a visual aid, saying that the exact same information appears on the what? The open, high, low, and then close bar chart. You remember this. The advantages of what candlestick charting are, candlesticks are easy to interpret and are a good place for beginners to start figuring out chart analysis. So bear in mind. So actually, we are using this for your sake, right? Even though I use candlestick. Now I am abreast with this. I can decide to choose any color that I want. So on my phone, I use different chart of what? Colors, color patterns. And then on my PC, I use another different set of them. But they all have the same idea. Whether it is bullish or bearish, they are the same. They are the same, right? Now, candlesticks are easy to use. Your eyes adapt most immediately to the information in the bar notation. Plus, research shows that visuals help with studying. You may know this. So it might help with trading as well. That's simple. All of that. Candlesticks and candlestick parties have cool names, right? Such as the shooting star. You learn about these things. We have different types of candlestick parties. This is what found in what intermediate what playlist. You can visit that. If you're a beginner, don't worry yourself doing that. Let's finish this before you do that. But if you are intermediate, you can still visit that. You have the link is in the description. So that is it. Now, which helps you to remember what the pattern means. Candlesticks are good at identifying market turning points. Trend reversal, you learn about them from an uptrend to a downtrend or downtrend to an uptrend. You will learn more about this later. Good. There are many different types of charts available. One is not necessarily better than the other, right? but it's a matter of using which is easier for you, convenient. The data may be the same to create the chart, but the way that data is represented and interpreted will vary. Each chart will have its own advantages and disadvantages. You can choose any type or use any multiple type of charts for technical analysis. It all depends on your personal preference, like you said. Now that you know why candlesticks are so cool, and it is time to let you know that we will be using candlestick forex charts for most, if not for all forex chart examples on this platform, right? So putting them together in summary. Now, there are several different types. In fact, there are different types of price charts that traders can use to monitor the FX market, right? Keep things simple. That's the important thing. Keep things simple as you begin reading price charts. Don't complicate things. It's one of the downsides for amateurs when they start. They try to make things too lively and making it too difficult. Keep things easy, simple. Learn systematically, gradually. It is better. It is the best way to learn FX. Now, as you find your chart preferences, look for the proper balance of having enough information on the chart to make good trading decisions, but not so much information that your brain is paralyzed, right, and can't make any decision, like I said. So that is important. So thank you very much for being with us in this session. Please like and subscribe and share. If you need any personal assistance or personal lessons, please contact us. We do that. We talk to you and then we see how best we can go around it, right? So in the next episode, we treat what types of what traders, forex traders. Thank you very much for watching. See you in the next episode. Bye.